Wealthy and Wise is your guide to value investing, powered by Teaminvest.
Hello there, and welcome to this week's edition of Wealthy and Wise, where we slow investing down to cut through the jargon, take a look at some real companies, and tackle your questions, especially when markets get noisy. So it's all about learning to think like an owner, not a trader, and building wealth with structure and patience. So on today's episode, every investor, I think it's fair to say, wants to own the next unicorn, but what are they exactly? And think about dogs. The market apparently is full of them. But again, are these businesses that destroy capital slowly or very quickly? How do you tell the difference between the two? So we'll unpack warning signs of companies that are more likely to fail. Because did you know on the ASX, profitable and financially strong companies are actually the minority? So the challenge for investors perhaps isn't just finding the winners, it's avoiding the losers. So we'll put some companies under the microscope as well as answer your questions. So let's get started by adding value. And joining me here in studio to add value is Andrew Coleman, who's from Teaminvest, and we're also really pleased to welcome Brian Hahn, who's joining us from Morningstar. So the big question is, what makes a dog, what makes a unicorn, and why does it even matter? Andrew, I might start with you. Is this terminology that's widely accepted out in the marketplace?
Look, I think some of it is. Some of it may be being a bit more esoterically used by us today. But really, I think what we mean by that is a unicorn is a company that delivers investors a wonderful return, right up at the far right end of the bell curve of potential returns. And of course, by converse, a dog is something that ends up destroying investors' capital, right on the left tail of the distribution. So if you think about it, companies can be ranked anywhere from blowing up all your money, 100% loss of capital, to theoretically an infinite return on the other side of the spectrum. The unicorns are those close to the infinite, and the dogs are those close to the negative 100%. And of course, most companies, as you'd expect, fall somewhere in the middle. They're neither a dog nor a unicorn. Perhaps keeping with today's analogy, they're a zebra or a pussycat.
Okay, so how would you define a unicorn or a dog? Or how do you think about the market in terms of winners and losers?
Well, Nadine, unfortunately, you don't know a unicorn until it turns into a unicorn, and you don't know a dog until you lost a lot of money on the dog. So I guess what I try to think about is, it is really about the returns, unfortunately, in the market. The returns and the retrospective insight into that return determines how you label a stock. If you lost money for a long time, it's been going down, then it's obviously a dog. But unicorn, there are a lot of companies at face value that don't look like unicorns at all. They look like just normal horses. You talk about, say, an ARB corporation which makes tow bars and bull bars. At the time, nobody knew they were investing in unicorn, but they kept on delivering. Core fundamentals kept on improving. And you just look at the compounding, you stay patient, that was one of the words that you used in the intro, and before you know it, you turn around and go, gee, that was a unicorn, and I didn't even realize it was. So there is a lot of patience involved, and there is a lot of, scorecard keeping. You have a bunch of mileposts that you measure the performance against, and that's how you realize a unicorn over time. And unicorn certainly doesn't mean that you make 20% and get out of it and make a profit. It's the compounding of that over time.
So interesting. So what we are talking about here is not just share price performance. This is fundamentals, the business fundamentals.
Yeah, well, the only way a company can continue to compound and deliver amazing returns over time for a shareholder is if the company itself continues to grow and compound. You can't continue to extract blood from the stone. And I think something you talked about there that was quite interesting, and I'll just pick up on. I think most people, when they're new to investing, perhaps not so new to investing, they spend their time trying to find unicorns, mythical creatures. And of course, they were coined originally as unicorns in finance academia because they didn't exist. According to the efficient markets hypothesis, there was no way of telling who a unicorn was going to be in advance. And yet, I think it's very seductive for people to want to start investing in stock markets or be investing in the stock market and hope that on some bit of tip or some bit of new information, they're going to find the next unicorn, make $1 billion overnight. And it just doesn't happen. In fact, we know from peer-reviewed research for 60 odd years, they don't exist. Anytime they do exist, it's more flash than reality. On the other hand, of course, if we follow the lovely words of Carl Jacobi, famously requoted, of course, by Charlie Munger, when faced with a difficult problem, invert, always invert. The ability to pick dogs has been very well understood. That's not to say you'll get everyone, but there are some fundamental reasons in academic research that show finding a dog or the qualities that a dog is likely to have. And in fact, there's 27 of them, and you touched on some of them in the introduction. They're all common sense. It's things like if a business has never made a profit. We have to say in finance all the time that past performance is no guarantee of future performance, but what's a better predictor? If a company has never made a profit, the odds are next year it's not going to suddenly make an astronomical profit. Things like being ridiculously indebted. So we can talk about them all later, but I think what you start to learn the more you've been in the market is to stop trying to find unicorns, which is very, very difficult, and start trying to find dogs and avoid them, because the simple reality is the average of your returns will always be higher simply by excluding the worst performers.
Do you agree with that you should just try to avoid the dogs?
Definitely. First of all, I think dogs are easier to identify than unicorns. As I say, I've been in the market for many, many years, and I've never seen a unicorn early on.
Yeah.
It's always become a unicorn. And then the second thing is, as I personally get older, I do find that you find happiness by eliminating distractions and negatives from your life, instead of trying to find another thing to add to the basket and filling your life with more things. So when you combine those two principles, I do believe that avoiding dogs is probably easier. And the third thing I will say is, when your aim is to try to avoid dogs, your expectations are low. And as Charlie Munger famously said, the formula for happiness is result minus expectations.
This is a man speaking your language, Andrew.
We're going to get along great.
Yeah, so Andrew identified really high debt, no or low earnings, no profitability. What are other sort of signs that you look for in a company that would help inform your view that this is not something that's worth you losing sleep at night over?
Yeah, so those fundamentals: earnings, cash flow, debt. But I think management is very, very important. When you've been in the market for a long time, you will know when there's management that's full of promises, and yet when it comes to execution, it falls way behind. And when you've seen enough of them, you're going to miss a couple of management teams that you thought were full of crap, but they turned out to be really good executioners. But you're happy with that, you're content with that. But majority of the time, if management keeps on promising and yet not delivering on the execution, then probability is, you should avoid that one. And also, there are a lot of companies that are very opportunistic. So where there is a market thematic that's flavor of the month, you'll see all these companies, for example, a marginal little data center company will suddenly list on the stock market for no other reason than we're chasing a dream here, we're going to build it and they'll come, give us some money. And those are the sort of warning signs that you have to look out for.
Do you also steer clear of companies that are capital raising often or looking to tap the market?
Yeah, I mean, look, if a company is consistently mining its shareholders' wallets, it's very hard as a shareholder to get a meaningful return from it. That's not to say that it can't happen, it's just to say that there's better uses of your capital elsewhere. And, we talked about trying to avoid dogs is easier, but it's also more profitable. The average return of the ASX is about 8.5% per annum for the last 20 years. The average return of the ASX without the bottom performers, though, has been around 15% per annum. So simply holding the index without the few biggest losers actually materially increases your wealth. And of course, anyone with a little bit of a maths background gets that intuitively, because the right side of the distribution, the positive returns, is relatively uncapped. A company can keep compounding for a very long time. And of course, the left side of the distribution caps at minus 100. You can only blow up the money you've put in. So just taking out a few minus 100s materially improves the average as a whole. So here, I think you can overthink this, as we talk about a lot. You don't need to try and find the dog as in the company that's going to get you 6% instead of 8.5%. If you just simply avoid the ones that blow up your wealth, as Buffett would have said, rule 1, don't lose money, rule 2, never forget rule 1, you end up with a very strong return, much better than the market average.
So you raise a good point though, Brian, because we get these thematics, it's basically a trend, and a lot of people love jumping on these trendy trains. But can it also work in the opposite way, as in a good company can just be caught up in an unloved sector?
Oh, definitely, Nadine. Just in the past few months, we've had, if you weren't in technology to start with, and then if you weren't in data centers, And if you were in oil, gold, and their resources, then you would have been holding a stock that's been considered a dog because they've been underperforming. But that's just the flavour of the month thing, you know, because when you look at the compounders, they go through thick and thin. And then when you look at the real unicorns, I mean, then if you look at, for instance, FedEx or even Amazon, things like that, they've been through some tough times. There were times when they were really precariously close to bankruptcy, and yet they came through. And the point I'm trying to make is a lot of luck involved, as in life. A lot of luck involved in some of these companies becoming unicorns. A lot of fork in the road where they took the right one, like Netflix. Instead of getting bought out by Blockbuster, they said, you know what, we'll have a go ourselves. And so there is a lot of luck, but those are flavour of the month thematics. You have to be very careful about those. And what I recommend to your listeners and viewers is that if you are going to go into the flavour of the month, just admit to yourself that you're not investing. And that's totally fine. But don't expect to invest in a unicorn by going to flavour of the month, because you're basically trading. And be happy with that.
What's that lovely Buffettism? If you think you can dance in and out of securities and make a profit, I'd love to be your broker, but not your dance partner.
So what practical strategies, because this is what this program is about, can everyday investors use to balance that seeking opportunities, minimizing exposure to those dogs? Is it good old-fashioned work, Brian?
Yeah, and I think young people call it grinding. There's a lot of grinding involved. But one thing you can do is this. You can reduce your investment universe. Concentrate on things that you understand, you sort of understand, or you're willing to learn about. And therefore, you cut out all the noise, because you admit to yourself that you cannot pick every single winner. So focus on the things that you understand, and also you can cut your investment universe by a lot of other criteria that fit within your own sort of personal values. You might say, you know, there are companies that sell products that I don't like or are morally against. Well, cut them out. I don't like companies that don't make any profit at the bottom line. Well, cut them out. And focus on the universe that you really feel like you can grind away, put some effort into understanding them. I think that's always a good start. And then secondly, again, I go back to one of the words that you mentioned in your intro, patience. You are never going to get a good compounder if you keep on selling and buying. So those are probably the first things that I'll say.
Anything to add?
Yeah, look, I agree with that. I think we're at Teaminvest, we're quite lucky because we built software for our members over time that sort of does the heavy lifting, helps filter the universe down. But all of your points are exactly what we're trying to do. And if you think about it, there are far more dogs out there on the ASX than I think the average investor realises. I mean, there's just under 2,000 companies listed on the ASX, and only approximately 80 of them at any time, which is 4%, show none of the 27 academic signs of being a potential dog. And even if you think that might be too harsh a measure, and just say, what about the ones that are really barking loudly? So if you think about that, over 1,000 companies on the ASX, 1,084 of them in last reporting period, were loss-making. That's more than 50% of companies. 463, so about 25% of the ASX, have a current ratio of less than 1. In other words, their short-term liabilities exceed their short-term assets. Now, taking accounting speak out of that, in general parlance, you'd call them at risk of being insolvent. They're genuinely unable to meet their liabilities as and when they fall due. And of those 463, 199 of them, or 10% of the ASX, has negative shareholders' equity and owes more in debt than they have in capital, which by pretty much most definitions is about as close to bankrupt as you can get it. So, if you just exclude those maybe 199 worst from your universe, perhaps the ones we think of as dogs howling at the moon, then almost by certainty of inverting that, you're going to end up with a return above the market and be happy compounding for a long time.
Indeed, it's like having friends. Instead of trying to get another good friend, if you eliminate all the toxic friends, you'll be much happier.
I like your thinking. Brian Han from Morningstar, pleasure to have you join us. Really appreciate it. Andrew Coleman as well, Teaminvest. Stick around after the break. We're going to go head to head with some dogs, unicorns, some dogs masquerading as unicorns, and we'll see what other combinations we can get to. Let's go head to head. Well, now it's time to have a little bit of fun and name some names. Now, we're not here to name and shame, but our next guests do have views on what makes, let's call it a dog stock, and what makes a unicorn stock. There we go. Did you know that there are more dogs than you may think listed? As you just heard, Andrew Coleman from Teaminvest gave us the stats. Apparently more than half of the ASX is loss-making. So welcome back to Andrew Coleman from Teaminvest, and joining us as well is Marc Whittaker from IML, Investors Mutual. Marc, welcome.
Thanks,
Just introduce us. Like, what kind of investors are you at IML?
So IML Investors Mutual, we would traditionally be called value investors. So we look for, ideally I think what we'd like to say, we're actually quality investors, but we like to buy quality stocks at reasonable prices. So we don't want to overpay for a good company. If we find a good company, we want to buy at the right price. So when we talk about what a quality company is, we're talking about competitive advantage, growing earnings, recurring earnings, and capable management teams. So I focus on quality, but at the right price. That would be us in a nutshell.
Yeah, well, I mean, that's what we're here to discuss. So we had a conversation earlier with Brian Henn from Morningstar about dogs versus unicorns. And, you know, for those of you watching out there, I don't think that these are official terms listed in Investopedia. But then again, we don't think that unicorns really exist to keep the kids away. Spoiler alert. But you get the concept, right? That unicorns are elusive, hard
That's
to find,
right. Yeah.
that dogs are easier to identify.
I mean, finding the ultimately highest quality company is very difficult, and as you point out, they probably don't exist. Every company's got its really good points. Many companies have their really bad points, and often it's the right time in the cycle to buy a particular company, which is what drives the approach or the attitude of the investor base to a particular company. If a company's doing well, it's typically a unicorn, and if a company's going through some operational challenges, often it's called a dog. So it's really time and place as much as anything. And some companies are generally operationally challenged as well, and they could be a more conventional type dog stock, I guess you could argue.
Yeah, okay. So let's get into some companies, shall we? All right, so look, if I had to pick some companies that perhaps, it's not just that they're going through a rough period, it's that maybe their whole entire business is on the verge of being blown up, I would think Star Entertainment comes to mind.
Yeah, I mean, look, I think, you know, anyone who's suffered the 97% plus reduction in your wealth by being a shareholder in Star over the last few years would probably agree with you. But I think what's interesting is, you know, in many ways this was foreseeable, maybe not 10 years ago, but certainly along that journey. You know, Star became over time a sort of poster child for ticking more and more of those signals that we said before in academic research. So a business is a potential dog, you know, highly volatile revenue, earnings that were falling off a cliff, regulatory challenges, questions around management. And, you know, even when it entered into the very beginnings of the prosecution issues, it was still trading at $3.97 a share. So from that point of view, you know, if you had been caught up holding this in your portfolio, maybe due to a previous view on the Star Group, you had an opportunity to get out at $3.97 when the fleas were hopping around and very visible. The challenge, of course, is if you held on to it, hoping that that dog would, you know, get better and maybe put on a fresh lick of paint and have a bath. Sales and earnings fell more and more. Regulatory challenges have got better and better. And, you know, from that point of view, maybe you can make money out of it now at 12 cents, but I hope you didn't pay $4 for it.
No, I think when you combine complexity and regulation, it's never a great mix. And when things get too hard, often that's because they are. And despite the best efforts of management and the best quality management team you could have in place, if things are difficult, they're difficult. And running the ship or you know, washing the dog, or whatever the case may be, it's often a Herculean task, and one that's not often that successful.
So what do you say to investors, Marc, you know, that might say, well, that's deep value though, deep value, or is that just something to be very careful of?
No, there's two arguments. I mean, you could argue there's some real asset backing on the balance sheet as well with Star, so you could look at it from a balance sheet perspective and say there is value there. I mean, I think the earnings story is very much impaired though, so ultimately when you own equities, what are you looking for? You're looking for capital growth, so share price growth, and you're looking for ideally a revenue stream, dividends or some sort of capital return back to shareholders. You're not likely to get that with Star in either case. So it could well be a deep value play, but it could be deep value for a long period of time as well. And there's an opportunity cost in holding stocks as well, which aren't delivering. They're not paying you to hold them while they're going through their operational turnaround or issues. So can you find better ideas elsewhere? That's always the question, isn't it? The dilemma. This is great value, but if it's deep value, it looks really difficult, but it could be tremendous upside. Or there's a stock over here which looks really good. It's doing well, it's a little bit more expensive, but I can see a pathway to growth and earnings over time.
Don't complicate your life necessarily by holding.
Keep it simple.
Yeah. KISS. when Ausbiz launched almost 6 years ago, we talked a lot about a company called EML. We interviewed the CEO of the time many times. It was sort of a gift card business running overseas, and then they started to have regulatory problems, particularly in Ireland. Is this, and it's been talked many times as a turnaround story, is that what EML is for you?
Well, I mean, they'd have to turn it around when you look at that chart, wouldn't they? Because they're not going to make any money if that continues to be the current performance. I mean, again, this is another example of a company who's was exhibiting many of the signs of being a potential dog long before the regulatory challenges. The regulatory challenges were just maybe the final nail in the coffin. It had a market cap at one point of $2.5 billion on revenue of under 100 million and profits of, and I'm quoting here, $0.0 million. Any time a market cap is $2.5 billion for a company that makes less than 100 million in sales and doesn't make profit, that is likely to destroy your wealth. The question is just how much wealth will be destroyed. Now, it's turned out the number is well over 90% if you bought in at that period because the regulatory challenges followed. But even if the regulatory challenges hadn't followed, at some point the market average PE was going to kick in of around sort of 18 to 20 times, and 18 to 20 times zero is still zero. So, from that point of view, a value investor who's looking at the underlying fundamentals and is not trying to complicate their life by buying stories. And we've got to remember that it's the job of management to sell a really good story about why their company is going to be worth something. No CEO lasts in the role and no chairman of the board lasts in the role if they stand in front of you at Ausbiz and say, well, we don't make any profit, we don't know how to make any profit, and we'll just keep raising money in hope. I mean, that's not going to work, right? So they've got to have a good story. But as an investor, you don't have to buy the story. You don't have to search for that mythical unicorn. You can say, this has got fleas, let me stay away.
So would you have looked at the books of EML and sort of seen some of the
Yeah,
trouble
no, we
coming?
looked at it a number of times over the years. I think for us it was more a case of, again, there was complexity about this business. Yes, it was sort of gift cards and prepaid cards, but it kept morphing into something a little bit different geographies, different product offerings,
acquisitions as well,
a host of acquisitions. And so I guess the thesis for owning it initially began to sort of creep, and the reasons for owning it would change. And so ideally when you're owning a stock, you've got a very sound, highly convicted thesis for owning that stock. You understand what you're owning, you know why you want to own it, there's a price you want to pay for it, and you've got a pretty firm view on why you would like to own this particular stock. As the thesis changes and creeps and you've got to find more reasons for justifying owning that position, it becomes more of a, well, am I owning this stock for the right reasons? Do I actually understand what I'm owning? And when we see volatility in markets and people start to panic and they start to sell things, often they sell things that they hold that they don't actually understand why they own it, or they don't really understand the business model, how this makes money, how is it impacted by what's going on in the world at the moment. So just getting those theses right, those understandings right, I think is quite key.
All right, so look, referencing that really interesting AI-generated photo, I would say, of the dog in the shadow of a unicorn. How, Andrew, do you sort of look at those companies that, maybe you could say are pretending to be unicorns?
Yeah, I think we mentioned it before. I mean, it's management's job and the board's job to talk up the prospects of the company. I mean, one would argue their job is really to run the business, but the ASX sort of seems to take the view that talking up the stock is often better than running the company. But my cynicism aside, there are lots of companies out there that trade on very large market caps on the hope that they will get it right. In other words, ignore what the evidence of your eyes are. Eventually the emperor will have clothes. And from that point of view, we jokingly at Teaminvest call them dogs masquerading as unicorns. They're really a dog with a cone strapped on their head. If you've read Thelma the Unicorn, as we were talking about before, maybe a pony with a carrot on their head and a bit of pink paint. And they are constantly being described as a unicorn in the hope that something will come good. So I'm not blaming management for that. That's their job, and broker's job is to see the positive in that. But there are certainly companies out there that have very large market caps, have destroyed a lot of shareholders' wealth, and have very limited prospects of recovering. Well, a good example, and we've got a few that we talked about earlier before the show, but just a couple off the top of my head, Myer and Healius are two, and I think we can probably talk about
Okay, well,
them.
let's bring up the information that we have for Myer, because in its most recent report, and it does, I think, report out a cycle, the cost of business was down, online sales are expected to be achieving double-digit sales growth. We've still got Solly Liu, the biggest shareholder. He'll also be joining the board in 2028. It's got Perpetual, Vanguard, Wilson Asset Management, Norges Investment Bank as its biggest shareholders. Why is this a dog?
Well, I think it's got all of those as shareholders, with the exception of Solly, because it's so large. Because it's inside the ASX 200 and probably inside the ASX 50 maybe even. It naturally attracts big investors because the nature of our rules in this country are such that if you're a large investor and you don't hold who's in the index, you can get penalised quite heavily with both fund flow and regulatory challenges. But if you look at Myer as a business, I mean, this is a business that you would think would print money. It's got a huge brand moat, it's highly regarded, it's got huge opportunities around competitive advantages in both its purchasing power and the brands it can shop. And yet, roughly 1 year in 3, it blows up a big chunk of shareholders' money with a failed venture. And it sits there with a huge amount of debt on its books. And if you've been a shareholder over the last 10 years, you've lost 75% of your money in that period with no prospect necessarily of the many mooted turnarounds ever changing that. I mean, Myer's been listed, well, initially before PE took it out and then put back on the market now for well over 100 years. The last 20 of them, can you find me a 2-year period where they haven't been talking about a turnaround?
Can we?
Every dog has its day, and we've actually made money. We have made money on Myer in the past. I think with the saying in retail is detail. So you've got to get it right. The offering's got to be right. The displays have to be right. The financials have to be right. And under John King, if you go back a couple of years, I think there was a genuine turnaround there from where it was, and the story was certainly a much better narrative under John. Obviously, there's been a change in management since John stepped back, and we have Olivia in charge now. Again, it's just about constant attention to detail. A lot of the stocks that we cover and that we look to own across the ASX, it's really about management's attention to detail. It's one or two things. There's a couple of key value drivers. You've got to get those right. If you don't get those right, it makes things really difficult. So I think in the case of Myer, they've obviously acquired those other businesses from Premier as well that they brought into the group. You could argue those additions aren't as high a quality as perhaps what was in the core Myer business. So is the business a better business today than it was, say, 3 or 4 years ago under John King? I would argue it probably isn't. So you've had a degradation of quality, you could argue. And then what's the right price to pay? Again, it's retail, it's highly leveraged, it's interest rates, it's consumer sentiment. It's not always easy to get it right. And when you're running a brand of brands, essentially, which is what Myer is, it's concessions, but largely concession stores within a Myer department store. Getting that offering right, positioning, making sure you're constantly selling and upselling to the right demographic, it's actually quite hard. So finding a good quality retailer on the ASX is actually quite difficult.
Yeah, I was going to say, so Myer for you right now is in the too hard basket.
Well, it's going through change. I think it's made some acquisitions which aren't ideal.
Yeah.
And there are, again, I would argue opportunity cost. There are better retail offerings out there on the ASX at the moment.
You mentioned Healius, Andrew. What's wrong with Healius? I mean, I know that it as well has gone through a change. Some have said that it's sold off some of its best assets. You got execution risk there, I suppose, but what really makes it a dog? Because it's offering a service, that we need, that is...
So that's exactly the point I wanted to talk up. We're talking about dogs masquerading as unicorns. I think if you didn't show anyone any of the numbers about Healius, in other words, if you suspended disbelief on what's been occurring and you said, what I've got is Australia's largest pathology provider, so testing for diseases, given what's been happening in the world over the last decade, how much do you think the business has grown? And I think almost anyone off the top of your head would have said, I don't know, 4, 5, 6 times. The world is using this service more and more. They've got an enviable position. They're the dominant player in the space.
I see COVID
the brands
there.
are well regarded. You can see COVID. And with the exception of the COVID year, Healius is 20% smaller in sales now than it was 10 years ago. That's not even profit. Ignore the profit for a second. They literally are able to get less money from doing a good that must be in higher demand than they were a decade ago. And that's my point about dogs masquerading a unicorn, because the story sells itself. Pathology services, dominant player in Australia, we're a medical haven, this works, right? But the reality is the execution of that company, whether it's their fault or it's industry dynamics, I'm not qualified to opine, says that they've managed to shrink consistently over 10 years, both in sales at about 6% per annum and in revenue and in earnings by significantly more than that, as you just saw on the chart. And to fund those losses, they are now leveraged at 1.5 times their equity, which is starting to get pretty dangerous from the perspective of a shareholder, because of course with that much leverage, one of two things is going to happen. Either the bank is going to call it in, and as a shareholder you're going to get in serious trouble, or they'll preemptively raise new equity to pay off some of that debt, in which case you're going to be diluted on a business that was already shrinking.
But is the only way up for a company like Healius?
I think our issue with Healius, I mean, I think pathology generally is an okay space to look at. Indexation, Medicare indexation is an issue for the sector. They don't quite get the same indexation that other areas in healthcare get. So with pathology, it's a constant daily grind to keep your costs under control. It's about margins. Can you expand your margins? Whether your top line's growing or whether it's flat, are you getting ahead of your costs? Basically, your collection centres where you go to donate blood, there's labour around that. There's labour within the laboratories, analysing the samples and so forth. And those wages are going up all the time. So the big chunk of your cost base is labour, it's people. AI may help in the future, potentially, but in the here and now, labour is your big issue. So how do you stay ahead of that labour inflation? And when you haven't got indexation, it's about basically labour management. Healius haven't made any investment in their labour management information systems, the laboratory systems, for a long period of time. They're doing that now. They're claiming some success on that front, but it's really hard. It's a grind. And if you don't get it right, what you see is an earnings line that heads backwards quite dramatically. We like Australian Clinical Labs in that space because they've made that investment in their information systems. They know where to allocate labour. We've got demand over here. We need to get samples from this laboratory to that one because we've got an overburden here and an underburden there. It's about capacity utilisation. Let's get those samples through the lab as quickly as we can, get them out, get the next batch of samples in.
And that's higher quality in your view.
And that's healthcare, but it's a basic industrial process. Utilisation, capacity, just work that machinery as hard as you can, and sweat the assets. The assets.
Look, we talked a little bit about thematics. You can't look past gold through 2025 and into 2026.
Yes.
What do you make of some of the small cap gold stocks? Are they?
I hate gold stocks. We haven't owned enough of them, so that's been a bit of an issue. But well, for me, I think when you look at the smaller part of the market, I think small cap resource stocks are some of the most volatile stocks you can own over a period of time. Yes, gold's been going well, rare earths has been performing well, but these are cyclical companies, right? They're exposed to a commodity at the end of the day, and that moves to a cycle. And so I think you always just need to be a little bit mindful that if you're exposed to a commodity, so you don't have any pricing power as a commodity producer. You dig out gold from the ground and you sell out whatever the price is. You don't have any control over that. You don't have control over demand. Your supply is always an issue because once you dig the hole and you dig out the gold or the commodity, guess what? You've got to find another hole. So often these companies in really boom times, they're generating heaps of cash, but guess where that cash goes? It doesn't really go to shareholders. It goes to digging the next hole, finding the next deposit. So I think if I ran a general screen over small cap gold miners a few weeks ago, and I think out of 17 or 18 stocks, about 3 or 4 that actually pay dividend. And it's a nominal dividend too, because we're building these huge cash reserves to find the next hole, to find the next deposit. Your reason for being is to find more gold and then dig that out of the ground and then sell that. So as a shareholder, we talked about capital growth, and I talked about capital growth, and I talked about sustainable growing dividends over time. You don't really get that with small cap resource stocks as such. So in a BHP, you could argue is a very different, very diversified portfolio. Small cap miners, often one asset, one commodity, exposed to the headwinds and tailwinds of the cycle.
All right, so that's one of Marc's dog areas of the market. I like that. So can we talk then, just to be clear, we sort of touched upon some of the things that you're looking to avoid in stocks. So what would a potential unicorn be listed now?
Yeah, I mean, look, a couple of them that immediately come to mind: TechnologyOne, Supply Networks, REA Group. And I think if you have a look, and I think we can pull the charts up, just contrast that with what we've been talking about in dogs. We've been being a bit tongue-in-cheek and a bit negative on these things, but these are companies that are really struggling to make money and are heavily indebted. So they're not making profit for shareholders, and they're constantly at risk of diluting you further as they raise capital to just try and stay afloat. And on the other hand, we do have some really wonderful companies out here. I mean, if you take a look at TechnologyOne, I mean, here's a company that's grown its underlying earnings at north of 15% per annum for 20 odd years, with a stability of around 98%, no debt. I mean, look at that chart in comparison. I mean, without knowing anything about the company, it's pretty obvious that is going to have delivered a wonderful return to shareholders. Now, to Marc's point before, you can still overpay for it and blow your money up because you get caught up in a bubble, and I think that happened probably 6 to 12 months ago with T&E when it got around $40 a share. That was insanity because the PE ratio was like 100 times, and history does not tell you anything other than companies whose PE ratios come that high come crashing down. But the company itself is a unicorn. Supply Networks, if you bring up the chart, you're going to see a similar thing in REA Group the same. Now, the challenge for an investor, of course, is, you know, you're looking to avoid in stocks. And I think if you have a look, and I think we can pull the charts up, just contrast that with what we've been talking about in dogs. I mean, we've been being a bit tongue-in-cheek and a bit negative on these things, but these are companies that are really struggling to make money and are heavily indebted. So they're not making profit for shareholders, and they're constantly at risk of diluting you further as they raise capital to just try and stay afloat. And on the other hand, we do have some really wonderful companies out here. I mean, if you take a look at TechnologyOne, I mean, here's a company that's grown its underlying earnings at north of 15% per annum for 20 odd years, with a stability of around 98%, no debt. I mean, look at that chart in comparison. I mean, to make sure that you play in that space and you remain disciplined in what you're prepared to pay for a company like that. Because the company itself is a unicorn, but it will only be a good investment to you, not to the company itself, if you pay a reasonable price. And you know, you can look at that in a PE metric or whatever you want to use, but you know, from our point of view, it's those two things that you want. You want a company whose earnings are growing with a high degree of stability, with no other signs of being a dog, available at a reasonable price.
So would you agree TechnologyOne, REA, and I think it was Supply Networks are...
I think they're all very good businesses.
Yeah.
I think REA is a particularly good example for us at the moment because we've just started nibbling away at that one. So it's a stock that we've always thought was a very good business. You know, digital classifieds or online marketplaces, they're the dominant player in that real estate category, that vertical. First mover advantage, they're always going to be the number one. There are concerns about AI, and obviously we've got the volatility in the market at the moment. But I think the moat around that business is a very strong moat. So when we think about the companies we want to own, it's the barriers to entry. What are the sustainable competitive advantages? And when you are the go-to aggregator of buyers and sellers in the real estate industry in Australia, you've got a very dominant market position, and it's very hard to see how they'll be dislodged from that. You might have question marks on the ability to price further over time and so forth, but in terms of the industry positioning that they have, their ability to attract liquidity. If you think about a stock exchange, what drives the stock exchange is liquidity. It's buyers and sellers buying shares. Realestate.com is pretty much the same thing, right? It's attracting property listings, it's attracting interested buyers, it's bringing them together. And so I think that's a very powerful model. Our issue over many years has just been the price that the market's been willing to pay for it, that we haven't been willing to pay. We love the volatility at the moment in a way because it's giving us a chance to look at companies like this and say, well, you know what, it's starting to look a little bit more interesting now. We can actually justify taking a position in a stock like REA. TechOne and Supply Networks might be a little bit more expensive and haven't quite fallen back as far as we'd probably like, but if you can get an REA today at where it's trading on a sort of 30 times the PE, which is still not great, but it's far less punchy than what it's been, it's just starting to get a little bit more interesting.
Yeah, okay, so then that brings me maybe to the last sort of part of this conversation. How about those companies that are quality companies, that are bringing in cash, that are making a profit, but that their share price is just not being reflected? Yeah. Right. I mean, are they dogs, or are they unicorns, or what are they?
I guess it's the opposite. It's a unicorn hiding or masquerading as a dog. But I mean, Cleanaway for me is, I think, a classic example of a great business, really well positioned. We talked about the industry positioning of a realestate.com. I think with Cleanaway, it's the leading waste management company in the country. Now, if there's one thing that's immune or immutable to wars in Iran, oil prices in the Middle East, or issues in Europe, it's Australian waste volumes. People are still going to produce things, they're still going to consume things, and there's going to be waste volumes associated with that.
That's that halo trade, right? Heavy asset, low obsolescence. I've learned that.
That's right. So it's very much a halo cannon. I wasn't going to use that term, Nadine, but since you brought it up. So it's really, it's got a very significant amount of invested capital. So it's got obviously garbage trucks and fleet. It's also got, and so that's called the collection part of the business. So you're collecting waste volumes. The container deposit schemes in New South Wales are run by Cleanaway, for example. So the beauty of the business is they collect the waste streams, and then they also have a post-collections business. So whether it goes to landfill, whether it goes to recycling, whether it goes to other forms of waste disposal or recycling, they've got that post-collections business. And so that post-collections business pulls through the volume from the collections business. So picking up the curbside bin, the green bin, the yellow bin, the red bin, and so forth. So it's a wonderfully integrated business. The issue the market's had with it in the past has been to build that position has taken a lot of money and some time. So they've got a lot of invested capital in the business now. But what we should see from this point on is that they should be reaping the benefits of that investment. So the cash flow profile for the business should improve dramatically over the next 3 to 5 years.
Okay, so that is
Marc's. That's why I like it.
Yeah, that's unicorn masquerading as a dog. Just in the interest of time, I'm not going to ask for a response to Cleanaway. What's one that we can do our research on that you've got in mind?
Well, I mean, let's have a look at Jumbo Interactive. So, I mean, Jumbo Interactive's an online provider of lottery software. So the software that manages lotteries, whether that's for the Lottery Corporation or for charities in Australia and the United Kingdom, and now a little bit in the United States. And here's a business that has a 10-year track record of very high return on equity, north of 30%, very low debt, growing earnings at double digits every year for the last 10 years with a huge degree of stability. Profits increased 8-fold over the last 10 years, so an 8-bagger in terms of profits, and yet is currently on a PE of 13.5, which puts it right in the sort of bottom quartile of those companies listed on the ASX. That's the market doing, as Benjamin Graham put it so well, in the short term being a voting mechanism, in the long term being a weighing mechanism. For whatever reason, the market has voted that they don't like jumbo. That's fine, they used to love jumbo. But geez, as a value investor, how can you go past that? I mean, a company looking like that in that chart, with that degree of stability and moat, available on a PE of 13 sounds like a wonderful investment long term. Yeah. You can never be certain, something could change, but unless it changes, that's going to do very well for you.
But you got to be patient, right?
Yep.
Because sometimes it's not going to. I mean, everybody's not going to wake up tomorrow morning and flip the switch on jumbo.
You just need a couple of big Powerball jackpots, and the story will change very quickly. So again, it's about where the market's at a point in time, how the stock's performing, and the narratives can change quite quickly on the ASX.
Okay, listen, I would love to continue going through stocks in this regard. Maybe we'll do a take two of this thematic at some point. Mark, I hope that you can stick around. We've got a viewer question. I would love you to weigh in. All right, we'll be back to answer your question. So Marc Whittaker from Investors Mutual and Andrew Coleman from Teaminvest are here to answer your questions. Please, if you have one for the Wealthy and Wise team, you can send it to wealthy@ausbiz.com.au. And today's has come from Jeremy. And Jeremy, I don't blame you for asking. He writes, the headlines are really negative right now. What's one thing an investor should do when markets are in a tailspin and uncertainty is rising? So let's try to answer that question. Andrew, I'll start with you, because I mean, the world has been wild lately. You can't wake up any given day without, a headline screaming at you. So what do you do?
I think the world's always wild. I think that's the funny thing, is that every sort of period we live through we think is more volatile than the period before, and yet the period before was just as volatile. I mean, it wasn't that long ago we had questions of how was the world economy going to hold up in a pandemic. These are not new volatility. What I would say though is don't be the lemming and jump off the cliff alongside everyone else, in the same way as I would say don't be the fool who runs in trying to fly alongside Icarus when the bubble rises. Remain calm. As a value investor, it's a really easy game. All you need to do is find companies that aren't showing signs of going bankrupt, hold them for the long term, and let compounding do the rest. So unless what's in your portfolio genuinely worries you that because of what's going on in the world, that business may cease to exist, the odds are time is going to be your friend by waiting and watching. Now, if it's got fleas and they're jumping around, and we gave some examples before of businesses who were showing fleas well before they ended up becoming destroyed, get out and get out fast, because no matter what you end up being able to have held on and get for a return, you'd have been better off with your money elsewhere. But if the company itself that you hold isn't showing fleas, just ride it out. Volatility is fleeting. If it's got fleas, jump.
Yeah, keep your head. I think that's the summation of that. I think, as we referenced before, if you know what you own and why you own it, and you understand the reasons for wanting it in your portfolio, and the valuation makes sense, there's no need to panic and panic sell and chase the herd out the door. I think fundamentals count. Fundamentals are important. I think markets often lose sight of the fact that at the end of the day, it's fundamentals that drive share prices. So we can have bubbles and speculation all you like, and particular sectors within the index can move on based on investor enthusiasm or excitement, or whatever the case may be. But ultimately, at the end of the day, it's about fundamentals. And if a company's growing earnings over time, if it's got a good market position, if the valuation makes sense, there's a good return on invested capital or shareholder equity, and it's run by a good management team, those businesses are likely to keep producing over time. And I think there's a myriad of examples of that. There's also a myriad of examples of companies that shoot, as we may say, aim for the stars and blow up all the way to the moon. But you just got to keep your head and be sensible. Know what you own, why you own it, and are you paying the right price for it? And often volatility can be your friend in a perverse sort of way, because often there's an opportunity to buy more of what you like, right? If the market wants to sell, put the market on sale, good quality stocks on sale because of a temporary dislocation, whether it's Iran or other geopolitical issues, oil prices and so on, volatility can be your friend. Buy more of what you like and what you already own because you like it. It's a good business. But if you're speculating, if you're trading and not investing, that's a very different issue. That's where you get in trouble.
Well, Marc Whittaker, Investors Mutual, it's been a pleasure to have you join us.
Thanks,
Andrew
Amy.
Coleman from Teaminvest as well. Thanks for watching Wealthy and Wise. We look forward to seeing you next week.
Wealthy and Wise is your guide to value investing, powered by Teaminvest.